All right. Good morning, everybody. Good morning, John Walkup. How are you today?
I'm doing great, Noah. It's always a pleasure to join you on Monday Macro.
Macro Monday.
Macro Monday.
I don't care.
Is that what we're calling it?
We've only been doing it for about a
words.
year and a half, 2 years now.
I think they're interchangeable. I'm just gonna talk over you the entire time. That's my new shtick.
I'm blaming it on the humidity out there. That's what I'm blaming it on, the heat and humidity. We're just messing around, guys, waiting for a few people to come on there. That is John Walkup. I am Noah Rosenblatt. We're both with UrbanDigs, and it is a Monday, so you guys are going to get a little macro Monday coming right at you. For those of you that are new to this show, we got to start out with Manhattan real estate. Take a couple of looks at these monthly trends really quick, and then we're going to go to a lot of macro topics. I can see all those tabs on the top of my screen over here. We'll follow up and end with Manhattan real estate. We'll try to do all of this in 30 minutes or less. We would love to hear all of your comments and chats. Please put your comments in here. We want you guys to engage with us. And remember, none of this stuff is financial advice. Don't start day trading.
I just want to have a shout out to all our viewers from France. Happy Bastille Day, July 14th.
Oh, excellent.
For our international lack of viewers, but
do we have any viewers in France?
But I just want to cover the bases. That's what people do these days.
All right. I don't think we have a really big French following here. But if we do, happy Bastille Day. Thank you, John. All right, let's get to it, guys.
I'm going to pause you because we're going to talk about this later, but we're putting out an article in Forbes and we're talking about how the city might be on sale for European investors or European buyers in a sense. So perhaps
that's right.
Perhaps there might be some euro holding French people who are interested. But someone even writes in "Vive la France." So there we go.
I love it. There's definitely a dollar play potentially going on right over here. So we'll keep an eye on that and talk about that later. But let's just start, guys, with Manhattan. I am on the market snapshot. This is right on your dashboard. I'm just scrolling down right here. Market snapshot, Manhattan, 1 month. Let's take a quick look at where we are, guys. Supply, 30 days, 1,037. We're mid-month, right? So we're still counting half of June. So we got June 14th to July 13th. So mid-month check-in. This is supposed to be at 1171 at the end of this month, and we're already well below it, Johnny.
Yeah.
So
it's been trending lower, and so it's no surprise that while we're in summer, it's not really a month for July. So I'm not really a month for supply. So if you're not close to it by now, you're probably not going to reach it by the end.
Yeah, it's going to probably go up and down a little bit until we get to the end of the month, but I would think new listing activity is going to fall for the next 2 weeks. So I would expect this to come in below 1171, which is our average for July. Now, contract activity, we're at 875. Our average for July is 917. So both of these measures are trending below average right now, John. Look at liquidity. We're down 2% last year. We spent the first 6 months beating year over year. It was up like pretty much the whole time, and now we're down. We gave it all up. Gave it all up.
The air left the balloon. There's a giant hissing sound through mid-April, and that was it. So now we're sort of, keep the balloon in the air. This is a really tricky time because it's almost out of helium and it's like really close to the ground. You gotta get horizontal to get that up.
Yeah, the air's going out of the balloon. If you're looking at this market pulse really quick and you say, well, I understand demand's going down. Why is this going up? The answer is because supply is falling faster than demand. That's the only reason what's going on here is this is a supply-driven uptrend. This typically happens in the transition from active months to non-active months, seasonally speaking, like July. So this is a supply-driven uptrend right here. It doesn't really mean if it was a demand-driven uptrend. If this was going up, demand-driven, liquidity, then I would say, yeah, it probably feels that way. But it's supply-driven. So it doesn't really feel that way. That's what that is. Okay, so just use caution on that. Okay. Johnny, questions, comments, anything?
Nope, all good. We have some people wishing us happy Bastille Day, so thank you.
All right. Let's take a look at credit spread alert here. I'm going to go open this up right over here, refresh it. Credit spreads, guys, we're shifting to the macro portion of the program here. Credit spreads are our guide to the internal health of the credit system that backbones this entire global economy, whatever you want to call it. If you want to know what credit spreads are, I like to hit the max button on this chart. And just take a look at the great financial crisis right here. Okay, that's when credit stress basically got to this highest level of our little credit spread indicator here. We created this credit spread indicator to make it easy for you guys to see whether or not credit stress is at a moderate level, high level, low level, and which way it's going. Because bottom line is, if this goes up, if this credit stress goes to the right, that means that there's rising credit stress, and that could trigger a risk off period. Stocks go down. Typically, bond yields go down, but sometimes that's not the case lately. But generally speaking, this could turn into something really, really, really ugly, like the great financial crisis or the pandemic, or it could not, like we saw in April with Liberation Day when it went up and then it stopped. So as far as I'm concerned, credit spreads are generally down. But Johnny, we haven't talked about this in about a week and a half with the holidays. Look at what's going on the last 7 days. We're kind of inching higher. This is what you were saying. But
I mean, we've had some extra liberation over the weekend, right? So we had more tariff announcements, and that's really my concern, was like the headline risk is out there. So I think credit spread alert was, there's a little bit of complacency built into it as we're heading down. I think a lot of the risks had been sort of understood to be sort of in the background, and I think they're pushed right to the forefront. The difference now between when it first happened in April is that tick up is much less and much more severe. I mean, it almost went vertical when it first happened. This is a little bit subdued still. So I think there's caution, but there's not the sense of fear that initially gripped the markets when this first came out.
Yeah, we keep an eye on this. We did tick higher, guys. The last time we talked about this, we were at stage 1.6. Now we're at 2.1. So this did tick higher. I want to explain really quick what this whole credit spread stage level indicator is, just for 2 seconds, guys. John and I built this, okay? It has 4 stages, okay? 1, 2, 3, 4. We are at stage 2.1. Each stage has 1, 2, 3, 4, 5, 6. Okay, 1, 2, 3, 4, 5, 6. 6 sublevels. So we are at stage 2.1. And we just came from stage 1.6. So we are somewhere in the middle of these 2 stages. And it may go back, it may go up and down and up and down. I don't like to really look at this until it moves 2 moves. So if this goes to 2.2, I'm going to go look at the stock market and see if there's something going on with the stock market. Right. And then if it goes higher to 2.3 and 2.4, I think this was what, John, 2.5 up here?
Something like that. Yeah.
Yeah, we got all the way up here last time.
Yeah.
So we moved 1 move. Doesn't mean you panic, but you keep an eye on it, right? That's what we do here.
Yep.
Okay. Final thoughts, credit spreads, John?
No, I think the only thing I'd say is, if you can overlap the S&P on there, right? I mean, it's reached a record high, right? And it's just it's kind of going sideways, which is kind of what this is telling you, right? Which is a little bit of caution has crept back into the market. So they're not powering higher, sort of going sideways until they get some clarity on which way we're going to go here.
Yeah. Keep an eye on this. We got to watch if this little tick up turns into something. Okay, guys, we'll watch this.
That's good. Is it a tick up or is it a hiccup? I like that.
That's great, John.
I like to play with words sometimes.
Look at this guy. He's taking his production skills to a next level in front of our eyes, ladies and gentlemen. It's really incredible. Johnny, excellent.
Magician. Yes, thank you.
All right, guys, let's go to rates. For those of you that have been following us, we have a format here. We're going to go from credit spreads right to rates. I am at the FedWatch CME group. All right. I'm looking at the probabilities table. You guys could do this yourself. Okay. We are here. The next Fed meetings are listed on the left side right here. July 30th is the next meeting. 95% chance, Johnny, of a pause. 95% pause. No move. Next meeting. The meeting after that, though, looks like we got a cut, 61%. This is pretty much the same as last time, I think, right there. 1 cut. So what you need to know is the first cut is September. The October meeting is in the exact same bucket, so there's no cut there, okay? Second cut is December. That's your second cut, and these are quarter-point cuts. I kind of don't want you to look, hey, I'm going to look at all these other cuts back down here. We're going all the way down to this level over here by October of next year. Guys, we don't even know what the hell's going to happen by October of this year.
I mean, look, even if you look at the July one, right, just to quote Dumb and Dumber, if you think about a cut, you're like, so you're saying there's a chance, right? There's there's definitely a non-zero chance they might cut. I don't think they're going to cut. I think they're definitely going to hold steady for July. I don't think there's a reason to cut. The percentage chance for the rate cut after that has gone down a couple percentage points from when we last looked at it, but it's still in the 60% zone. It's still I don't want to say it's a sure thing, but I think the market's counting on it. But again, there's a long time between now and when is that cut? Is that August, September, right?
September.
It's September. There's a long time between now and September. So anything could happen, but right now the market's looking at it. I think that's even that. I'm not even comfortable with saying there's going to be a cut in September at this point.
Yeah. This is right. The 36%, no move is gradually rising. We're stealing from this and going to this, but the market still has a cut. So the way you verbiate this, guy, let me tell you how you verbiate this, okay? In case you're talking to Wall Street people or whatever. Hey, according to the Fed Fund Futures, which is what this is, the Fed Fund Futures, there's a 61% chance of the first cut in September, okay? And a 43% chance of a second cut in December. That's below 50%. Anything below 50%, we're not going to pin any confidence on, guys. Anything after that is too far out. So you tell people, I don't want to look too far out. You're starting to get to low percentages here, 34, 29. I don't want to put my reputation on the line. It's possible you get one cut and that's it.
Yeah.
So that's what's going on there. And John, I found this.
Can you go back? We got some questions.
Oh, shit.
Good luck.
Sorry.
Go ahead. China store.
Did I just curse?
Can the inflation report tomorrow affect the estimate for the July 30th FOMC?
What's coming out tomorrow?
Well, the inflation report. I don't know which one is coming out tomorrow, to be honest.
Okay.
I haven't looked at that. I don't know what the
Either
data set is. But yes, I think all of that. Look, the Fed is extremely data driven. They've made that quite clear from the beginning that they're going to be waiting on data. And I think that's one of the reasons why we have a rift between the current administration and the chair of the Fed, Jerome Powell, is that Powell is basically waiting on the data, and the administration wants him to be a little bit more hawkish and act on this. Or dovish rather, and act dovish on the idea that the economy could use a rate cut. So could it affect the estimate for July? Totally. So, but again, yes. I mean, the July one that's like a 90, what is that percentage? 90 something right there?
95.3%.
95%. So, I mean, maybe it'll bring it down a little bit, but I don't want to say it's set in stone, but it's, it's like, it's drawn in wet cement. How about that? So
yeah,
it's drying quickly.
Yeah, the answer is yes to that question. And these could change. And quite frankly, if anything, I think it's going to change moving it to the right side of this table. I don't know.
And yeah, Jeffrey writes in and says inflation figures have been rather subdued. They have. And I think that's why we're still seeing the majority of these cuts work their way to the left of the screen, right? That's the idea of cuts, because inflation has been subdued. But again, I think the Fed's still waiting. And I think we still have some tariff action that's out there that is, it might not affect the July one or even the September one, but you start looking beyond that. Once these goods get to port, the tariffs are assessed. Like there could be some issues there. Last question here is, what's the current average interest rate?
Well, we're in between 4.25 and 4.5. Sorry. This is the Fed funds rate, FFR, Fed funds rate. This is the benchmark rate. This is how the Fed controls rates, right? They control the benchmark, and then mortgage rates kind of get priced off of that. Well, everything gets priced off that kind of thing. Mortgage rates actually get priced off mortgage bonds, to be honest with you. But generally speaking, it's about 200, 250 basis points above this. We'll get to mortgage rates in a second. Okay. What was the actual question, John? Sorry, I got lost in what I was saying.
What's the current average interest rate? So when we're looking at this, this is the federal funds rate, which, yeah, go ahead, Noah.
Yeah, no, finish up.
No, I was going to say, so it's
right.
Those interest rates on the top, that's what basically the Fed is charging banks to store money at the Fed. So that's how they control the monetary environment.
Right. So that benchmark's at 4.25 to 4.5. It's probably in the middle. It's like 4.375, somewhere in the middle there. They use a window. And then here's mortgage rates. I'm going to skip over this. I'm going to come back to this right here. It's important. Here's mortgage rates, guys. Look at the top. Focus on the white line on the top. That's your 30-year mortgage rate. Okay. It's not jumbos or anything like that. It's just your 30-year mortgage rate at the upper sixes, right? So you got the Fed funds at 425 to 450. And you got the mortgage rate like 200, 240 basis points, 2.4% above the Fed funds rate. Sorry with the pulp basis points thing. But but that's about where it is. And you take a look at mortgage rates. I mean, we're kind of in this, I don't even know what you call it, but like, we're in this like channel. I don't know, somewhere in this channel. And the last time we've been in this channel is like, look at this, going all the way back to about 20 years ago, 30 years ago, Johnny, 1990. Oh my God, 35 years ago. Oh my God. I feel like it's 1998 already in my head for some reason. I can't believe it's 35 years.
It's crazy because I remember when I was like in college and I was like looking at some data, or you hear someone talk, well, 30 years ago, who cares about that? And now here I am like, oh yeah, 35 years ago. That's an interesting trend. Anywho, I digress. To me, the point is more, I prefer looking at the bottom chart because I think that's more emblematic of what's happening in the market. That's basically the almost the rate of change, period over period. And that change since the Fed started raising interest rates, tax day-ish, April 2022, has just, I think this has been head and shoulders above any other period we've seen. And I think that's really, to me, the emotional driver of this market is the fact that mortgages were essentially free 3 years ago, and now they're expensive. So I think we've had that shift. I think that's an emotional shift. I think that's what's keeping out a lot of the buyers of the sub, at least in the Manhattan and the Brooklyn markets, sub 2 million, sub million market. It's really kind of keeping them out because we've gone from free to expensive almost overnight, and it's really hurting. Whereas the luxury market's kind of doing its own thing. But when you look at the average mortgage rate, right, you're right. We're sort of in a channel. We're not at our highs. Certainly nowhere near the highs that the market saw in the late 80s, mid 80s or so, even in the early 90s.
Yeah, going back
but
there.
Again, I think it's that rate of change, which is what's really sort of spooked folks.
Yeah. And so now the question is, where do we go from here, right? So now the question is, where do we go from here? The market is pricing in 2 cuts this year. If that happens, maybe you see rates go down a little bit. I mean, we're kind of where we are in because we are pricing that in now. I mean, it's possible. Here's the thing. The Fed may cut, but when the cut comes, the statement that accompanies the cut might change the future expectations of how many more cuts are coming, and rates could not do what you think they might do, guys. So like, let me give you an example. Yeah, it's very important you understand this. So the Fed cuts rates quarter point, and you're like, oh, I got a Fed cut rate, that's going to go down, and all of a sudden the Fed comes out with a statement and says, you know what? We don't expect any more rate cuts. We think we're going to be here for a while. Meanwhile, this has all these other rate cuts. So now all of these blue things go to the right. That means this is going to go up. This 6.77 might go up. And that's like when a company has earnings and they beat the earnings and the stock plummets. It's because they don't care about the earnings today. The market doesn't give a crap about today. The market cares about 2, 3, 4, 5, 6 months down the road. And how are those expectations changing? So keep that in mind. That's what drives rates.
That's a great point. And I just want to that actually brings up a couple questions. Someone asked, why are the interest rates dropping? Doesn't that usually happen just before a rate drop?
It's noise. This is noise. Let me show you. This right here, like, we're noisy now. We're just going up and down in this channel based on the news of the day.
Yep. The next, can we even rely on data these days? The Fed may be honest brokers, so to speak, but generally government output has to be suspect. I think that's a fair point. And I think back in January, February of this year, there was a lot of talk about, well, what is it? What are we measuring now? Have we changed the inputs on some of the measurements? So honestly, I haven't followed up on that discussion. I'm not quite sure if there's reliability issues, but for the most part, I think the data is understood to be reliable, more or less.
I mean, it's a really good question. This Trueflation thing. This Trueflation thing has us at 1.7 or so. I don't know what this tick up is over here, but I mean, like, there's different measures.
I love this site, but I always forget it. What is it?
Trueflation.
That's a good one.
Trueflation. But it has thinking like, I don't like the way the government's measuring this stuff. Let's measure it how we think it should be measured. Again, and this kind of argues for a cut or two. This kind of says the Fed's a little restrictive and we should get a cut or two. Great question. I don't know. We'll see how it all plays out. I mean, there's a debate there. But look at the Fed member. Look at the FOMC, the Federal Open Market Committee. Okay, FOMC. Fed, these are the guys that are voting on policy, and they're flat out telling you where they are. So like neutral, right? Neutral's in the middle. all the way in the left is down one full percent. Down 1 full percent. So that means down to like this level here, right? Right over here, down 1 full percent. Okay. Look at this guy. Who brought this Waller guy in here?
Money should be free.
And then look at the right. These are the Hawks. The right is the Hawks. Is that we should be higher. We should be higher, right? And you got a lot more people kind of, going over that side, even though the majority is like, we're going to cut a little bit and then go kind of thing. So it's really interesting to look at this chart and where the members lay. Lie? I don't know what the word is.
Lie. I would probably say lie. I think that, look, I mean, you take all these people, you put the median. I mean, the median's pretty much where we are right now, or very, very close to it. So,
yeah, one cut, one maybe. I mean, like, just to tell you guys where I think this is headed, we're here now. We're in that spot now. I mean, it's kind of like somewhere around there. Looks like potentially 1, maybe 2. I don't know. We'll see. Keep an eye on that. Okay. So we saw mortgage rates. We see where the Fed is. We see all that kind of stuff. Johnny, you talked about the dollar. Take a look at the green line, guys. The green line. The blue line is 10-year Treasury yields. Typically, these two track each other. Typically, it's only a couple-year chart, so it's not going back. So keep that in mind. But I mean, there's not really any denying that since the whole trade war started, that these things are now separated. The dollar index going way, way down. John, you had a point, I think a Forbes article talking about potentially a value play for Manhattan real estate.
Yeah, and that's coming out. I think it's coming out this week. It depends on when it finally gets, clears all the hurdles and gets posted. But basically, when you look at, and I think we have some charts on this, but we might share. But basically, when you look at like resale, Manhattan resale, Brooklyn resale, condos, or new development, the price action is mainly going sideways, even up.
What would I do here?
And
all right,
when you value it in euros or pounds or Swedish crowns, it's down. So Manhattan and Brooklyn, to some extent, are on sale for select foreign currencies. Are actually seeing some double digit discounts for real estate here. So I'm curious if that's going to spark any interest, and I'm curious, and I'll pitch this to the audience. I'm just curious if anyone's seen any interest from international buyers who are like, oh, wow, my money goes a lot farther now. And, here's the kicker. If look, I know cap rates are low. I get it. So it's really difficult to kind of, make ends meet if you're just buying a single condo and renting it out. However, if you buy it in euros or pounds, you get that conversion. And if rents start going up and the currency starts appreciating, you just get a little nice tailwind there. So interesting time.
It's nice to see it from a currency play, but what stinks is the whole policy sides of the other side that may be muting this a little bit. I think investors might be just a little wary with what's going on with all the policy changes that have happened here. But I wonder if this is actually having an effect in and of itself on its own, or if there's other factors at play that have to align for this to have a bigger impact, kind of a thing, because I don't know how investors are looking at us right now. Yeah, I just don't know. But interesting nonetheless. I'm curious what you guys say, if you guys are hearing anything. Okay. Dollar down, guys. Dollar down. That's probably why stocks are up. I mean, holy crap. Have you looked at crypto lately? I mean, Bitcoin's at like $123,000. What the heck is gold, Bitcoin, everything not priced in dollars is just soaring. It's crazy. They're talking about,
writing it into, making it a legitimate currency, which would be huge for the crypto community. Right. Was it worth $123,000 per Bitcoin? I mean, that's anybody's guess.
I feel like that's like an example of like, I don't know. I'm not going to say nobody believes in it, because there's a whole community there that is just, very much into believing it. But I mean, I just didn't believe it. I was always waiting for it to come down. I wonder if there's other people like me out there that's like, they didn't quite buy into it. They expected it to pop, and it just keeps going up. It just keeps going up. It's just like the stock market kind of. But meanwhile, money market funds. I mean, John, what do you make of this? Money on the sidelines, so to speak. I kind of hate this whole money on the sidelines thing, because stocks are a zero-sum game. For every buyer, there's a seller. But $7.4 trillion sitting in money market funds right now.
I get it. I mean, look where the market is. I mean, you yourself have talked about the idea of the market is climbing a wall of worry, and that's what powers rallies, right? It's just every tick higher is just like, oh man, it's just white knuckle all the way. So I can understand why a lot of folks are like, I don't know, I'm a little worried about this. I'd rather collect my 4.5%, 5% or whatever it is I can get in the money market than, buy here at the top and then watch the markets, tank 20%. I think that's certainly a worry, and I share that worry. I'm one of these people that's making up this green spike.
So like I'm just looking at 2009, not to it's, I mean, we're not anywhere near like that, but just looking at that last time. Well, I guess you could look at over here the pandemic too, kind of thing, I guess, right before. It goes up usually when there's like something bad going on, it goes up. But like stocks at record highs and this is just keep rising. They just don't buy into it, I guess.
Well,
I don't know.
I think you have a combination of things. I think you have the stock market record highs. I think you have a lot of worries about the valuations. But then I also think you have somewhat decent short-term rates. So it used to be that if you're putting your money in like a high yield account at your bank, you're getting a whopping 25 basis points a year. That's 0.25% a year. And you're like, yeah, I'm doing something good. I got a relationship to get that. And now it's like you get 4.5, 4.75. Like you're actually getting good rates, like whether you're in short-term T-bills, whether you're in the money market, like it's acceptable. So I think the risk of being in the market versus not being in the market, I think, is what's really powering this higher.
It's crazy. A lot of money sitting on the sidelines.
Someone writes that we have a question. How is AI affecting this? That's a really great question. So I think AI is really powering a lot. I mean, powering a lot of the moves here. You think about some of the big players out there, right? I mean, Meta, NVIDIA, et cetera. Meta had like $100 million pay package for AI folks. So there's a huge focus on that. And then I think one of the things we talked about, was it last week or 2 weeks ago? The unemployment rate for recent college grads is really rising sharply as opposed to the other ones. And I think that's probably AI driven. So look, that's an issue. That's an issue. And I think, again, that adds to the worry about valuations. Yeah.
I feel like AI and crypto, this is like almost like the .com and the fiber plays back in the day. Fiber optics plays. Remember JDS Uniphase? God, that was fun trading those things. I digress. Anyway, let's go back to credit card delinquencies. That's a lot more fun than trading. By age, guys, by age group right here. These younger people are always at the higher points, but there's the consumer strong. There's nothing really to see here. It looks like it's going the other way. Looks like it's going down. So I don't know, this whole recession that we're supposed to hit, bankruptcies, debts, defaults, delinquency. I just don't think you're seeing it this cycle, not in the consumer. So I don't know. It's going to be interesting how this whole thing plays out. How does the Fed cut rates when all this is happening here?
Yeah, I think this also plays into where the Fed is. And I think if you overlaid the Fed funds rate on top of this, you'd probably get a very similar path, which is, I mean, you think about post Great Recession down to 2017, we just saw rate cut after rate cut after rate cut. And that's kind of what drove it down. And then again, during COVID, we saw rate cuts. So you see it go down again. And then, of course, rates sharply rise in 2022, and those numbers pop up. So we're definitely above where we were going back for the last 10 years or so, but we're nowhere near the levels that we saw in 2008, 2009 at the recession era. Still, I'd prefer these to be lower if I'm being honest, but they are not at critical levels, I don't think.
Yeah, they're coming down on their own without like a recession happening. You got to think back to 2009, really, what they were doing. The Fed, we were in the recession on the way up. It's coming down on its own naturally. So we'll see. And that's it, guys. I don't want to throw any more macro charts at you, but there's a few things going on over here. A couple of cuts, 1 to 2 cuts, September and December. Mortgage rates are sitting in the right area. Let's take a look. I'll show you. Mortgage rates are sitting right over there. Okay. More Fed members are starting to go a little bit to the right, a little bit more of the hawk side lately. So you may not get as many cuts as you originally think. Okay. The dollar just keeps going down, guys. They're going to inflate this debt away, it looks like, by the dollar. $7.4 trillion in money market funds. It's kind of crazy over here. And we arrived back in New York City real estate here. And I want to show you guys just a couple of things. First off, I want to take a look at this overlay right here, guys. We used to do this all the time. Break up monthly contract activity by under $1 million. That's the blue, right? Red is 1 to 2 million. Yellow is 2 to 4. And then over 4 million. Monthly contract activity for the last 6+ years. And it's not like it's telling us anything we don't already know, but we got a couple people asking us about this. So we figured we'd put this chart up for you guys to take screenshots of or whatever. John, what do you see here?
I mean, you can see that since April, basically, or March even, it was just the slow, steady. I mean, that when we talked about earlier, that's the air escaping the balloon. So it's pretty clear what's happening there. I mean, these levels are basically what we saw in 24, what we saw in 23.
Yeah, it's like a
it's
mixture.
Nothing really exciting. We're back to seasonality, and we're back to sort of a lower level on top of that. So it's just kind of a double whammy.
Yeah, that's right. What started out in the beginning of March as you know, this is the first time and since 2022 we're having a proper spring. It ended up kind of like a mixture of 23 and 24, kind of more like 24 shape and form. So sucks. And finally, guys, I wanted to show you this. I thought it was really super interesting. Take a look at the top line of this chart. That's the black line right there. That is your price action chart. That aligns with the left vertical axis. Resale, condo, price per square foot. It's price action. It's price action, guys. It has done a whole lot of nothing for the last decade or so. Okay. And it's starting, every day I update this and more sales come in, it's starting to actually go down just a little bit. Almost looks like we had our top. So I think we got another 2-3 months to fill into where we are today. We're probably lower right now, but take a look at that price action chart. Okay. And now take a look at the red line, which correlates to the right vertical axis and those two flags I got there. That is your listing climate. Guys, that's your listing climate. Easy is above the green line. Blue is below the challenging. We have deteriorated. We're just above the challenging level. But the point of this is that these two charts are doing completely different things. And while one's hanging on and just coming off record highs, the other is at very low levels, especially compared to like 10 years ago. So always keep in mind, you have to have both these conversations. Johnny, thoughts?
I like it. No, I like it. You know, I think there's a lot of stuff in this chart, and I think one of the things that is interesting to me is to understand just sort of the visual relationship. And I get both are kind of choppy, so it's hard to sort of see the one-to-one. But you can see in around 2012, 13, when the climate index just popped up to like the right axis up to almost 6. That's what really sort of set the stage for a run in prices, which lasted for a few years, even as the climate index cooled. So, then again, it popped again post-pandemic, right? We had that rush for anything that was renovated, ready to go, drove prices higher. And here, as the climate index has cooled a bit, prices are still stabilizing. So could we see them roll over more? Possibly, but it's almost like we vaulted up into the next level. So I'm really curious how this is going to look. I'm writing off the summer. I don't think we're going to see some sort of crazy amount of deal action happen in July or August, but I'd be very curious to see if buyers come back as per seasonality in September or especially October, November. And I'm curious if how that's going to affect the climate index and what that might do for prices. If buyers are going to start balking at the current prices, or they're going to demand more price cuts. So obviously we'll keep an eye on it, but I'm looking forward to seeing how that plays out.
Yeah, it's going to be really interesting, guys. Thank you, John, for that commentary. And guys, take a screenshot of this if you want. Talk about it with your clients. This is very important that you don't talk about one without the other, because I think the other, the red line specifically, resonates with how we all feel this market is doing. And I don't think clients are aware of it, sellers especially. I mean, they're out there, they're having trouble, but they don't see it. They probably just look at price action. Okay, guys? Yeah. So I thought that was very interesting. Final comments, Johnny. We have reached time.
Everyone says, what is your perspective of a possible Mamdani win on the New York real estate market? Do you have any thoughts, Noah?
Yeah, I got thoughts. I don't know. I mean, look, I don't agree with the guy's policies. I don't generally like socialism in general. That's not, I don't think that ever ends well. I guess the reaction that we're seeing now is that, it's just not a lot. It's a very, very, very light kind of thing. It's not real socialism kind of thing. But that's usually how it starts in my head. I don't know, for some reason. I don't know. I never lived under it. I kind of just studied it back in the day, kind of thing, like the rest, I think like most of us here in America here kind of thing. I don't know. I think you're going to have a high turnout, very, very, very high turnout, and we're going to see what New York wants. Personally, I don't know if it's going to be that great for investors, development and investors and all that. I just don't know. I think it might scare a lot of people. It's the unknown. It's the unknown of what may happen kind of thing. I don't know. Not in a position to talk about it. I don't have enough information.
Yeah, I think we need to see some actual policy proposals, cabinet ideas. I'm just curious, like what that might look like. But look, I'll just say that I'm really glad that New York City real estate is not priced off of general policies of the city, because there have been some real boneheaded ones in the past. And so if that were the case, the city would be just free. So luckily it's not, and luckily we can go forward. The city's a dynamic place, and I think what draws people to New York City is not necessarily the policies as much as it is the dynamism, the fact that you can walk out on the street and see 100 people and you feel like you've done something just setting foot outside. So I think that's a wonderful thing that this city offers, that not a lot, only a handful of cities around the world offer that. And I think in the United States, even there's not that many places that really compare to me to life and living in New York City. So I think that's what draws people here. I hope that's what keeps people here. And I hope that's what makes people want to invest here and come back. So I'll say that.
Yeah, well said. I hope so too. But we'll see what happens, guys. We'll see what happens. I'm curious what you guys think. I mean, should we have a webinar on this and bring some actual people that are familiar with both sides, maybe to talk about this? I don't know. Talking is good. Transparency is good. Information is good. It's a hot topic for sure because it's political. And we're in a very, very visceral political environment right now. But I mean, is this something you guys would want us to do, or is this just let it play out and see what happens and stick to Manhattan real estate? I mean, I don't know. You guys let us know. I prefer sticking to Manhattan real estate and focusing deep on this stuff, but I do understand at the same time that could have an effect on our markets. So
no, I think it's a good idea. I'd actually be open to that. I think it'd be a fun conversation to really dive in and understand, well, what's driving the fear and what's driving the hope.
Yeah. Hear all sides. All right, good stuff. Well, we've got out of time over here. I hope you guys got a couple of educated bits out of today. That's the whole purpose of the show. Thank you to John Walkup right over there. I am Noah Rosenblatt. We are both with UrbanDigs. This has been Macro Monday. We'll catch you guys next time. Cheers, everybody.
Thanks, everybody.
Good luck out there.